Hello, everyone. Welcome to Infinity's Wiser over the weekend. Today, we're going to speak about this very important topic, which a lot of people have in mind stock investing or equity mutual funds, which works better for us. So, let's go straight in. Equity, as you know, is the best yielding asset over the last few decades. So, take some examples of direct equity investors, some of the legendary ones who've, you can say, successfully compounded wealth for more than 25% over decades. Warren Buffett, Rakesh Jhunjhunwala, Peter Lynch, Philip Fisher, Michael Steinhardt. So these are all well-known legends in the space of equity investing. And compared to them, where they've compounded it more than 25%, some more than 30% as well, we've got simple and boring mutual funds, which have given more than 20% annual compounding for the last 15, 20 years. Why 15, 20 years? Because most mutual funds come with a 20, 25-year track record in India, not more than that. So there are funds from, which I'm not going to speak about specific funds. So I've just mentioned some of the fund houses which have got these kind of funds: Nippon, HDFC, Franklin, Aditya Birla, Sundaram, and others as well. More important, such high returns are unlikely in the future. So I'm not speaking about these to give you an idea about what you can expect in the future. And since we're speaking about mutual funds, don't forget mutual funds are subject to market risk. Read offer documents carefully before investing. Don't know why we don't speak the same way about equity investing, because that is also subject to market risk and a little more as well. So what should you choose? Well, you can choose stock investing if you have a passion for the markets. You like to study the markets, analyze companies, sectors, economy, then stock investing is for you. You also need to have a disciplined approach to stay focused irrespective of the market noise. Don't chase fads in the market, then you would be a great stock investor. You should choose equity funds if you're happy with decent or above average returns. You require the funds for your goals and are interested in a relatively smoother journey. I highlight relatively smoother compared to stock investing. You believe in the India growth story but don't have the time and expertise to track stocks, then equity funds is the best vehicle for you. Well, if you don't fit into either one of these, you've got the hybrid option like me as well. I've got mostly mutual funds in my portfolio, but as I love studying companies, keep in touch with the markets via direct equity and IPO investments. Again, we spoke about successful investors, but what I would want to highlight is that each of them have been very successful, but they've made multiple mistakes along their journey as well. Recently, Prashant Jain, who's, you can say, had about 30 years of, you can say, experience in markets. He's been a star fund manager, actually. He wrote his final letter when he was moving out of HDFC and says that over these 30 years, he invested in 474 stocks and made a mistake in one out of every four stocks. That is 25% hit ratio for him as well. And we've known Warren Buffett and Rakesh Jhunjhunwala and others as well who've made multiple mistakes. So I've just highlighted something which many of us will relate to. We know we've heard a lot of companies like Asian Paints, Bajaj Finance, HDFC Bank, Reliance, Infi, Lever, Titan, Nestle, who've compounded wealth over uh, many, many years. But uh, lesser said is, you can say, companies like Unitech, Reliance Power. So for every Reliance, there is a Reliance Power. For every HDFC Bank, there is a Yes Bank. And you've also got Future Group, Coffee Day, Suzlon, many others. Means I could have filled up many more slides with such companies where people do tend to make, you can say, investments in these and then become long-term investors. More recent examples are investments made by people in Paytm and LIC, where might be people thought you will make quick money, but now you become a long-term investor. So I put the infinity logo here as well, trying to think that we want to be a wall wherein we would want you can protect you from investing in such companies like the Unitex and Reliance Powers. So what does Infinity recommend? For people with a portfolio size, not a net worth, but a portfolio size of 10 crores and below, We would recommend mutual funds to form, equity mutual funds to form at least 80 to 90% of the portfolio, if not higher. Why only below 10 crores? Because above 10 crores, then you're not investing only for some goals, but you're investing more, you can say, to get that experience and to diversify the portfolio and things like that. Why do we recommend mutual funds more than direct equity investments? Well, our experience about of the last 18, 19 years since we've been working with people on their investments, 100% of our investors who've invested with us for 10 years and more have got meaningfully higher than double digit returns. Yes, 100%. So we follow Warren Buffett, who says rule number one is never to lose money, and rule number two is don't forget rule number one. So, with that in mind, we do recommend mutual funds. Though direct equity is, you can say, more interesting, it's more, you can say, macho, I would call it. Well, you can decide stocks or mutual funds, but the secret sauce for successful investments is this: gradually keep stepping up your investments periodically, and most important, give appropriate time, meaning think long term for your investments so that they can grow. Well, Infinity has ideas to make your money grow. Well, people don't listen to Warren Buffett, so unlikely that most of you will listen to me, but do try, and also do share this with your friends and family who can benefit from it. Thank you. Have a good weekend ahead.